When that structure tightens, it does not begin with panic. It begins with refinancing pressure, shrinking credit, and balance sheets that can no longer roll yesterday's promises into tomorrow. If it tightens again, it will not announce itself with sirens. It will show up in higher borrowing costs, in assets that stop rising, in governments forced to choose between inflation and contraction. And it will reach your savings, your rent, and your job security before it ever looks like a historic event. In 1929, the system did not slowly weaken. It hit a structural limit. For years, credit expansion had carried growth, speculation, and rising asset prices. As long as borrowing expanded, everything appeared stable. The moment expansion stalled, leverage reversed direction. Selling was no longer a decision, it was a requirement. People believed they were inside a modern, protected system. They were solvent while credit expanded. They were exposed the moment expansion stopped. And when the turn came, it did not ask permission. That is why 1929 still matters. Not because history repeats word for word, but because financial systems built on accelerating debt eventually face the same constraint. The names change, the technology changes, the arithmetic does not. Most people treat the Great Depression as a sealed chapter, a tragic but distant episode. It sits in black and white footage and old photographs, and the mind labels it as an exception. A one-time calamity caused by a unique madness, fixed by reforms, and safely contained in the past. That framing is comforting. It is also misleading. The deeper story was never about one crash. It was about structure. And structure does not disappear because time passes. It evolves. It scales. It hides behind new names. The most dangerous thing about 1929 is not the drama of the crash. It is what came before it, when everything seemed normal and improving. The crash was loud, but the commitment that made the crash inevitable was quiet. People did not wake up one day and choose collapse. They built a system that could not slow down without someone paying the cost immediately. And once that happens, you are no longer steering. You are maintaining speed because braking becomes too expensive. That is the first structural constraint. In the 1920s, leverage was not a technical detail. It was the culture. Speculation stopped being a niche activity and became a social signal. Ordinary people bought stocks on margin, not because they were reckless villains, but because the environment rewarded participation and mocked caution. Borrowing to buy shares felt like intelligence. Rising prices covered mistakes. Confidence covered risk. Newspapers called it a new era, and technology was real. Productivity gains were real. Cars, radios, electrification, mass production, these were not illusions. The danger was not that nothing was happening. The danger was that something was happening, and it made people forget that math still applied. Margin made the math fragile. When you borrow to buy an asset, the asset has to keep rising, or you get forced out. When enough people borrow, the entire market becomes sensitive to small declines. The market stops being a place where people express opinions and becomes a mechanism that enforces contracts. A small drop triggers margin calls. Margin calls trigger selling. Selling causes bigger drops. Bigger drops trigger more margin calls. What looks like panic is often just arithmetic catching up. But before the collapse, the environment trains you to believe that falling behind is more dangerous than taking risk. That belief turns leverage into commitment. It changes the psychology from this, "I want to go up," to this, "must keep going up." At that point, you cannot pause. Even a brief hesitation becomes costly because it reveals the leverage that was supposed to remain invisible. In 1929, the first constraint was the loss of the option to slow down gracefully. Today, the first door closes the same way, but it closes across a broader system.
Instead of margin loans concentrated in brokerage accounts, leverage is distributed.
Households carry mortgages, auto loans, student loans, and revolving credit. Corporations borrow to expand, to refinance old obligations, and often to buy back their own stock. Governments run persistent deficits funded through bond markets, and globally, total debt has climbed to a level that only makes sense if you assume the future will be friendly enough to roll the past forward without friction. That assumption is the modern equivalent of the 1920s faith that markets would always rise. It is not stated as belief. It is embedded as design. The system is built around the expectation that refinancing remains available, not forever in principle, but always in practice. The moment that expectation weakens, the first door has already moved. Because when debt grows faster than income, stability becomes a requirement, not a preference. The next structural pressure is credit expansion disguised as growth. In the late 1920s, consumption expanded on borrowed money. Installment plans made middle-class life feel larger. People bought cars and appliances with payments stretched into the future. Real estate boomed. Banks extended loans aggressively. Companies overstated profits, and investors rewarded the story. The economy grew, and it grew in ways that felt tangible. But the growth was partly financed by tomorrow's income, brought forward into today. This matters because credit-driven expansion is not neutral. It creates a hidden dependency. When credit is abundant, spending rises. When spending rises, revenue rises. When revenue rises, employment rises. This looks like prosperity, but the chain runs backward too. If credit tightens, spending weakens. If spending weakens, revenue falls. If revenue falls, layoffs begin. And once layoffs begin, the ability to service debt weakens, which makes lenders tighten further. That is not fear. That is structure. In 1929, credit was not the side story. It was the operating system. It amplified the boom and then amplified the bust. People did not merely lose paper wealth in the stock market. They lost the ability to roll debts. They lost access to loans. They lost access to liquidity. When credit freezes, modern life freezes with it. A 2 percentage point increase in borrowing costs does not sound catastrophic. But if mortgages reset higher, housing demand cools. If housing cools, construction slows. If construction slows, employment softens. If employment softens, tax revenue declines while social support costs rise. That widens deficits. Wider deficits require more borrowing at higher rates. What began as a modest rate adjustment becomes a reinforcing loop. That is how structure translates into daily life. Now look at today's economy. It is more sophisticated, more global, and more digitized, but it is still a credit machine. Consumer spending remains a central pillar. Corporate expansion often depends on borrowing. Government spending fills gaps when private demand weakens, and it does so through deficits financed by debt markets. You can call it stabilization. Structurally, it functions as dependence. If household wages do not rise fast enough to match living costs, debt fills the gap. If businesses face slowing demand, borrowing can cover the transition. If governments face political pressure, borrowing can postpone the trade-offs. Borrowing is a bridge. The question is whether the bridge leads somewhere productive or whether it has become the road itself. In 1929, too much of the bridge became the road. Consumption and investment leaned on credit expansion. When the expansion slowed, the underlying structure could not hold itself up. The system crossed a threshold when growth could no longer be sustained without continuously expanding credit. The next constraint is the interest rate trap. This is where modern parallels become sharper. because today's leverage is larger and more embedded. In the late 1920s, the Federal Reserve kept rates relatively low during expansion, then tightened when inflation and speculation became concerns. The tightening did not create fragility. It revealed fragility. A system built on easy credit suddenly faced higher costs. Liquidity contracted. Borrowers faced pressure. Markets that relied on cheap money discovered that cheap money had been doing more work than anyone wanted to admit. Today, central banks face a similar dilemma, but the scale is far greater. After years of near-zero rates and massive liquidity support, markets and governments adapted. Corporate debt expanded. Sovereign debt expanded. Asset prices rose. Real estate became less a place to live and more a leveraged asset. Entire portfolios were structured around the assumption that the cost of money would remain manageable. When inflation returned and central banks tightened, you saw the outlines of the trap. Borrowing costs rose. Refinancing became more expensive. Mortgage rates climbed, cooling housing activity. Banks holding long-duration assets faced losses as yields rose. Some institutions cracked under speed, not necessarily because they were the weakest in character, but because the system's design assumed stability in rates that no longer existed. This trap creates a corridor. Raise rates and you expose leverage and force losses to the surface. Lower rates and you risk sustaining the conditions that produced inflation and asset distortion in the first place. Either choice has consequences. The problem is not that policymakers are incompetent. The problem is that the system has inherited constraints from past decisions and past borrowing. In 1929, tightening turned a fragile market into a forced unwind. Today, tightening pressures households, corporations, and governments at the same time. When the debt stock is large enough, normal rates become abnormal. The system starts treating normal as an emergency. That is a structural sign, not a political insult. It means the system is losing the option of returning to ordinary conditions without breaking structures that adapted to extraordinary ones. The next phase is confidence turning into contagion. In October 1929, the shift was not gradual. Selling accelerated. Falling prices triggered margin calls. Margin calls forced more selling. The market moved from a place where people chose to sell to a machine that sold because contracts demanded it. The crash, dramatic as it was still not the Great Depression. It was the loud symptom. The deeper illness was what followed: banks failing, depositors panicking, credit freezing, businesses collapsing, trade contracting, and unemployment rising. Confidence is not just a mood, it is the decision to participate. It determines whether lenders extend credit and whether borrowers invest. It determines whether households spend and whether businesses hire. When confidence breaks, participation stops. And once participation stops, the system cannot be talked back into motion cheaply. In 1929, people initially believed confidence could be restored with reassurance. They misunderstood the disease. It wasn't merely panic, it was overexposure. Modern contagion is faster. The world is more interconnected. Capital moves instantly. Derivatives link institutions through complex exposures. A bank issue in one place can become a liquidity concern elsewhere quickly, not because people are irrational, but because they are trying to be early rather than late. In 1929, panic traveled by newspaper and word of mouth. Today, it travels by phone notification, social media, and algorithmic trade. When Silicon Valley Bank failed in 2023, the velocity of withdrawals illustrated something structural. The speed of fear now exceeds the speed of reassurance. Deposit insurance frameworks exist, but perception moves first. In a networked financial system, localized stress becomes systemic once containment fails. A shock does not have to be big to be contagious. It has to be fast. Another structural amplifier is inequality, converting financial stress into social fragility. In the 1920s, wealth concentration was extreme. A small segment of society held a disproportionate share of financial assets. A large portion of the population relied on wages and installment credit. When the crash came, the wealthy lost paper value. The working class lost employment and the ability to service debt. The system did not just fail financially, it failed socially. Breadlines became the symbol because they revealed the structure. Prosperity was not broadly resilient. It was unevenly distributed and therefore unevenly defended. Today, inequality functions as a stress amplifier. Asset ownership is concentrated. Rising stock markets and real estate prices disproportionately benefit those who already hold assets. If wages lag living costs, households become more dependent on credit. When rates rise and credit tightens, the pressure hits the most leveraged first. Today, the pressure is not theoretical. In the United States alone, trillions of dollars in government debt must be refinanced each year. When that debt rolls from near zero interest into materially higher yields, the cost difference is not abstract. It compounds into hundreds of billions in additional annual interest expense. That money does not build infrastructure or expand production. It services past borrowing. The same pattern repeats across Europe and emerging markets. Refinancing becomes the quiet battlefield where budgets tighten before headlines do. If housing prices stagnate or decline, those with minimal equity face stress faster. If layoffs rise, debt service becomes harder quickly. Inequality does not cause collapse by itself. It determines how stress spreads and how quickly it becomes political. A system with wide buffers can absorb shocks. A system where large segments operate close to the edge converts financial tightening into social instability faster. At that point, the buffer disappears for enough people that macro stress stops being theoretical and becomes immediate. The next structural shift is policy response becoming expectation, and expectation becoming leverage. During the Great Depression, policymakers initially underestimated the structural weakness. Later, sweeping reforms reshaped the system: deposit insurance, regulation, fiscal programs. Those reforms stabilized participation by changing rules. The state accepted responsibility for stability in ways it previously resisted. This helped. It also planted the seed of a new dynamic. Markets began to assume support during crises. In the modern era, that assumption is deeply embedded. Central banks provide liquidity during shocks. Governments deploy stimulus. Investors price assets with the expectation that severe dislocations will trigger intervention. This reduces immediate panic. It also changes incentives. If participants believe extreme downside will be cushioned, risk-taking adjusts. Corporate leverage can increase. Valuations can stretch. Debt can expand further. Not because people are evil, but because the system rewards positioning for rescue. This is where the language of moral hazard becomes real. When rescues are repeated, they stop looking like emergency measures and start looking like doctrine. Once doctrine forms, stepping away becomes its own crisis, because portfolios and balance sheets have been built around the assumption that support will arrive. At this stage, letting losses clear naturally becomes politically and financially unacceptable. So the system carries bad debt forward instead of resolving it cleanly. That keeps the surface intact while storing pressure underneath. The final structural multiplier is scale. The Great Depression spread internationally, but the world's financial architecture in the 1930s was small compared to today. Modern markets operate at planetary scale. Sovereign debt markets are integrated. Supply chains span continents. Currency markets trade enormous volumes daily. Derivatives multiply exposures in ways that are difficult to map during calm periods and brutally obvious during stress. What 1929 did not have was algorithmic liquidity. Today, large portions of market activity are driven by automated systems reacting to volatility, momentum, and pricing discrepancies in milliseconds. These systems provide liquidity during calm conditions. During stress, they withdraw simultaneously. Liquidity that appears deep can evaporate in seconds. The structure is more efficient than in 1929.
It is also more synchronized. A sovereign default, a failed bond auction, a major bank insolvency, or a sharp repricing of government debt would not remain local. It would flow through pension funds, insurance companies, commercial banks, corporate treasuries, and household wealth. The interconnection built to spread opportunity also spreads stress. Scale magnifies consequence, and speed magnifies scale. This is why the ghost of 1929 matters. Not because it predicts identical collapse, but because it reveals a structural rhythm. In 1929, leverage expanded faster than income. Credit financed consumption. Interest rate changes exposed fragility. Contagion accelerated panic. Inequality amplified suffering. Policy lagged structural reality, then intervened heavily, changing expectations. Today, debt has expanded faster than output in many places. Credit sustains consumption. Rate adjustments pressure refinancing. Interconnection accelerates contagion. Inequality magnifies vulnerability. Policy operates within inherited constraints and expectations. The names are different. The instruments are more sophisticated. The scale is larger. The rhythm is recognizable. None of this is an argument for inevitable collapse tomorrow. It is an argument for structural awareness. The Great Depression did not begin with catastrophe. It began with confidence. It deepened because leverage met tightening conditions. It spread because participation collapsed faster than institutions could restore it cheaply. Modern economies have tools that did not exist in 1929. Deposit insurance, central bank coordination, better fiscal capacity, better data. But modern economies also carry higher leverage, greater interconnectedness, and larger absolute debt burdens. The tools are stronger, but the load is heavier. So the question is not whether markets will fluctuate. They always do. The question is whether the system relies on conditions that cannot persist indefinitely. Low enough rates, high enough liquidity, and easy enough refinancing to keep old promises from snapping into present losses. If debt continues to outpace income, if asset valuations depend on perpetual support, and if policy flexibility narrows as obligations expand, the mirror becomes harder to ignore. When people look back at 1929, they often ask how they didn't see. Many did, but growth was intoxicating. Innovation was real. Profits were strong. Skepticism felt unnecessary. Today, innovation is real. Growth exists. Markets function. Confidence remains. That does not make the structure safe. It makes the structure comfortable. And comfort is often the last thing people want to surrender voluntarily. The ghost of 1929 is not a warning of identical disaster. It is a reminder that leverage, credit dependency, rate traps, contagion, inequality, and policy expectations are not historical curiosities. They are recurring structural features. The next decade will not replicate the 1930s in costume. But if the underlying mechanics are ignored, the rhyme will not feel accidental when stress returns.
History does not repeat mechanically. It echoes structurally. The question is whether we recognize the echo early enough to act with choice instead of acting under force. Recognition still arrives by choice. Collapse does not.